If somebody comes to you and says, look, I need 100 grand, well, we've got to figure out how we get them that 100 grand. And that might be debt of finance, or it might be a business loan, or it might be a line of credit against, their property. There's lots of different ways of looking at it. And that's, that's the job of a broker.
Welcome to the Business Behind Your Business, conversations to help your business grow and thrive. Hi, I'm Paul Sweeney, founder of Pretium Solutions, chartered accountants and certified business advisors, hosting the Business Behind Your Business. Today we're talking to Jason Smith from Capital Plus Finance. We're looking at alternative ways of funding your business and some of the things you need to be aware of when looking for finance for your business. And Jason's going to explore some of the issues that business owners face when they're looking for finance and some of the traps that they fall into. So it's great to talk to Jason. Now, thank you for listening. If you've been with us on the journey, you would have heard a number of our experts contributing and talking on various topics. But to help us get the word out, we'd really appreciate it if you could jump on Apple, iTunes, or Apple Podcasts and leave a 5-star rating, because that would just help spread the word and help more business owners find out more about the key things that they need to know for the business behind their business. One of the reasons I love talking with Jason is not just that he's really good at finding finance and the right kind of finance for his clients, but Jason has a lot of experience in business and understands business and has been through the process of starting a business and growing a business successfully, and then starting yet another business. So it's great to have Jason involved, and a very passionate guy about small business, which is what we enjoy having. So we're going to be hearing from Jason. And of course, I'm Paul Sweeney. I've been working with small and medium businesses for over 25 years, and I do so as a chartered accountant, a tax agent, and a certified business advisor. So let's get stuck into it. So we're looking at the question of getting the right type of funding for your situation, for your business, to make a difference about how you grow your business successfully. And some of the questions we're going to answer today are about what kind of funding does your business need? What should you be doing before you seek finance? Why it's important to prepare a business and cash flow plan before you apply for finance. And we'll also talk about getting your financials right. What are the steps in preparing and submitting your finance application? And are there alternatives to borrowing? So what are the questions we're going to be looking to answer today? We're looking at why your business needs funding. What kind of business funding do you need? Do you actually need to get funding? So are there other things you could be doing? Why it's important to prepare your business and cash flow plans before you apply for finance. And we're going to talk about the need for financial statements and figures. And what are the steps in preparing and submitting your finance application? The last one we're going to have a quick look at is, are there alternatives to borrowing? So in doing this, the strategy for using funding, borrowing, any kind of borrowing, loans, finance, that should be part of your overall strategy for growing your business and running it more profitably. And now is actually a crucial time for all businesses. Cash flow is tight. We need to be more diligent about looking after our cash flow and looking at how we fund our business. What is our capacity to borrow? What is our capacity to make the repayments? So why borrow? And this is a question that comes up. Why should you borrow, and why shouldn't you borrow? And part of it comes down to the reason for why you borrow. And these common reasons are why a business would need finance. And one of the key ones is growth. So to grow your business, to bring in extra capacity. And that might involve purchasing an asset to help you produce more, or to replace an asset. It might be to change a finance type, or look for a better rate so that you're paying out less interest and requiring less cash. You might have a short-term cash flow issue, or you might need to do things like purchase inventory, particularly where you're importing. So I'm going to ask Jason to jump in here, because we need to talk about the things that you need to get right. And Jason, you've got some good information to share with us on this.
Yeah, I see a lot of this, Paul, and this is great what you've got here, the 5 things you must get right. So look, if we start off with the credit score, whether we like it or not, most lenders are going to look at your credit score. Some just have a straight out matrix that they need it to be over a certain score. It might be 500 or 600. in order for you to be, even eligible. Some look a little bit outside that. They look more at the financials and more at, how long you've been in business. But, for the businesses out there that aren't too familiar with credit scores, your credit score is simply a score of how your business and you are going personally. Now, if your business is going great and it's got a score of 600 and up, which is pretty decent, but your score's 200 or 300, which is really bad, you're not going to be able to get finance. It's going to be very difficult to get finance. So credit score is critical. Most of the credit scores are coming through Equifax, which is the main credit reporting agency in Australia. And look, good payment history, obviously. If we jump into that, what all lenders will do, whether it's for cash flow lending or whether it's equipment finance or asset finance, so that's, whether it's commercial vehicle or plant machinery or yellow goods, they want to know what your payment history is. So they want to know what your account conduct is with another lender. And if you're having dishonors or reversals and you're not paying on time, you haven't got a good chance of getting finance at the best rate. We can still get you finance, but it's not going to be at the best rate. Profitable trading, that makes things a lot easier if you're profitable, particularly during these times. So having management reports showing that you're profitable is really important. And that next one there dovetails into that next one there, which is having your financials up to date. Critical, understanding what your financials are. And knowing what your borrowing is for, that you're growing the business or you're fixing a short-term problem. So as a broker, the most important things for me is that the client has got a good credit score, is property backed. It just makes their life a lot easier if they're property backed. And when I say a lot easier, I mean in getting a great rate and getting the finance approved and just having their financials up to date. That's just really, really, really basic stuff, but really important stuff.
So when we talk about profitable trading, like it's not uncommon for a business to have a dip in trading at one point. How does that impact?
They'll look at the big picture, depending on what we're going for. Like if we're going for a $50,000 vehicle, they want to see that you're profitable and they'll look at a serviceability. But if we're talking about cash flowing, the growth of your business, and there might be some sort of line of credit and it's based on your debtors or based on your real estate security, they will take a deep dive into it and they will look at, why is it dipped? So they'll want to know why has it dipped, or why has gross profit gone down or gone up? Why is there more staff for the same outcome? If they've got stock, why is the stock turn slowed? Why you're holding more? So they look at everything like that. And there's credit analysts doing this, and they can be really interesting people to deal with. They're really great to deal with. They just dive into all that, and the job of a broker is to explain that to them, to understand the financials and explain to them, well, this is why down, or this is why the profitability dipped, and this is why it's going to come back up, and these are the steps that they're taking for it to come back up.
Great, fantastic. And of course, one of my favourites is actually justifying why you need to borrow or why you need to spend the money. So particularly when we see these incentives for buying assets, yep. I've seen a lot of people being encouraged to go and buy assets to get funding or to get a tax deduction, and so they'll borrow to buy the tax deduction. But the business really doesn't need the expense. Is that something you see a lot of?
I do. I see a lot of that. I do some really interesting things. We do the odd Porsche in businesses and the odd prestige, prestige car or supercar. And, Paul, we've done a few deals together where you've really drilled down on your client and said, hang on, do you really need this ute? And they've explained to you that they do. It's worked well for them. So, look, it's the first question that every lender wants to know. Even if it's buying a vehicle, they say, well, what will this do for the business? What are you going to do? Now, look, we did a Porsche Macan last week, $160,000 Porsche Macan. And look, the client was asset backed. They were very profitable and they'd been in business for over 20 years. So there wasn't a lot of questions asked around that because the business owner just wanted a Porsche Macan. And, he's going to be able to write off, I think it's $58,000, is it, Paul? Not even that, actually, because
up to the depreciation limit, yes.
Yeah, right off a certain amount. So look, I don't want to sound flippant about this, but I see a lot of people not keeping their feet on the ground, not having a particularly profitable business, and wanting to go out there and buy, an $80,000 car where probably they could be buying a $40,000 vehicle that's going to help with their business. And look, I say to my staff, sometimes they question why are they getting an $80,000 Ram. I go, well, it's not our, that's their accountant's job to just to reel them in there and say, look, do you really need this? My job's to see whether I can get it approved.
Good. So you do more than just your standard business loans and finance. So I know that you've got a debtor finance history, and there are some alternative types. Like most people still think of the traditional lending methods and types of loans. So can you sort of explain some of the alternatives there that are available that people might not know about?
Yeah, look, my background's debtor finance. So I sold a debtor finance business in 2016, and look, I'm passionate about debtor finance because I've seen what it's done for small businesses. There's a lot of debtor financiers out there now. So there's quite a bit of choice out there. So if we touch on debtor finance quickly, what I like about that is it really is still Australia's best kept secret. It's a $60 billion a year industry. Companies that are turning over, $500,000 a year up to $500 million a year are utilising debtor finance. Mm-hmm. It's just not really well talked about. It's becoming better known, but it's still a pretty good secret out there. So if we touch on debtor finance briefly, what it allows a business to do is if they are growing, or if they want to grow their business, they want to put on more staff, they want a new contract, or they need to buy some more stock, it allows them to use their unpaid invoices to fund the growth of their business. It's really simple. It just works like an unsecured overdraft, or I shouldn't say unsecured, it's secured by your debtor's ledger. Real estate security is not required. Can be a great way of growing your business. If you pick the right debtor finance, it can work out fantastically. Pick the wrong one, it can be expensive, and breaking up is painful and expensive. I won't go into what some debtor financiers do when you leave them, but it's not a great outcome. It's a lot more expensive than changing mortgages. Not everybody loves debtor finance. I did a little video on LinkedIn the other day and talked about how it can be a great way to fund your business. And somebody made the comment that, look, if you're using debtor finance, you've just got it all wrong, and you're not managing your cash flow. He was in transport, and I can understand where he's coming from. But you know what? If you're getting paid 60 days end of month and you're paying your subbies weekly, debtor finance is probably a pretty key part of your business. So that's what I like about debtor finance. I like that you're not actually borrowing money, Paul. You're just bringing forward payment of the work that you've already done. So that's debtor finance. What else did you want me to touch on there?
I guess that's what you just said is leading into one way of improving your cash flow, because what we talk about is shortening that cash flow cycle from the time you make a sale to when you get paid. And at the same time, you're paying out for your suppliers, so your subcontractors or your suppliers of inventory, or even just rent and wages, you're paying those out. So the shorter that time period from when you make a sale to when you get paid, the better that is. And if debtor finance helps you to do that, then that's a great outcome. Yeah. Of course, there's other ways you can improve your cash flow. Simple things like actually invoicing. A lot of professionals get very slack with invoicing, and so they'll do the work, and then they'll take 6 to 8 weeks to invoice, and then wonder why the client takes 2 to 3 months to pay them. So you've got this long period. So there are a lot of simple things you can do to improve your cash flow as well.
That's right.
Yeah. So I think improving cash, increasing your sales, or having a strategy to increase your sales and reducing your cash outflows. So, and look, refinancing might be a way of reducing your outflows, particularly if you've got a more expensive form of debt. Interest is a big cost for a lot of businesses. So if you can find a way of reducing the cash going out, then that's a much better outcome. So look, there are alternatives to borrowing. A lot of it, I think, when I say alternatives to borrowing, well, I think we're talking about traditional borrowing. So there are other ways. And I think that one other thing we've talked about in the past with improving your cash flow is this need to, when you're purchasing, particularly importing from overseas, and you have this having the need to pay your supplier before they'll release the goods, and then you'll get them 2 or 3 months later. So there's also funding for that available.
So that's trade finance. Lots of trade finance lenders out there at the moment. Some really good rates. That's a great way of funding that, that lag, because sometimes it is 60, 90 days before those goods arrive, and then you might have pre-sold those goods, but you still days to get paid. So lots of options out there, nice seamless options out there now for trade finance. Always has been. The banks have been in it for, forever. However, you've got to be in pretty good shape to be with the banks, but it can be very, very good interest rates as well. So there's some great tools out there to make sure you even locally, so if you're even paying your suppliers locally, there's lenders out there to do that too.
Oh, great. Good. And of course, one of the other things that people sometimes ask about is grants and incentives, and there are a few of those around at the moment. A lot of them have very tight criteria about what you can do, how you become eligible for them, but some of the more meaty grants, particularly around research and development or exporting or developing new products, can be quite substantial. But one of the problems with those grants is that they are after the fact. You often get the money after you've already spent the money, particularly with the research and development offsets. You often get that grant the following year after you've lodged your tax return. So you do need to manage your cash flow in those periods, but the grants are available there, but you do need to structure your business correctly to get them. A question we often get asked, Jason, is about funding for startups. Do you have any good news?
I don't have a lot of good news on this one, Paul, as we've discussed previously. Look, it's very difficult to get funding for startups. So if you're a startup and you're not property backed and you don't have a track record, then you've just got to run on the sniff of an oily rag and get 6 months trading and show some cash flow before somebody will consider giving you some money. All the lenders out there, they've done all their research, they've done all their analytics, and they know that a lot of startups fail. And these startups that we're talking about, you and I are talking about in the context today, is micro businesses. We're talking probably less than 10 staff to begin with. So, look, the good news is if you're property backed, if you own some real estate and you've got a little bit of equity, people will start to get interest. But the bad news is if you don't have that, it's really, really difficult.
Yeah, so there's not a lot of options available until you've got a trading history. So if you're looking to start a business, I think you need to do more planning at the beginning and look at what's your cash flow going to be and how you're going to fund those initial periods. Because you can start a business today, but you might not get any cash coming in from sales for the next 4, 6, 8 weeks. So you need to look at how you're going to fund that, and that comes from your other sources. So you need to be prepared. Planning always comes in. So I've seen plenty of examples of where clients, business owners have got this wrong. The whole process of applying for loans, or they've tried to use the wrong type of funding. So one example I've worked with was a supplier to the construction industry, had a bad year because they mismanaged some jobs and had a big loss and needed some new equipment. Overdraft was fully utilised, so they wanted to get an extension of that. So they went straight to the bank without talking to me first. And of course, the banks looked at their financial history for the last year and said, no way. And then they were unable to supply. So they had to then, we had this issue that they put in unsuccessful applications for finance, and that was affecting, again, their credit history or their credit file going forward. So fortunately, we were able to get an outcome where they were able to fund the purchase of those assets and not use that overdraft facility for the wrong time. So your overdraft really should be funding your short-term cash flow, in my view, or your working capital. So 3 to 6 months of expenses, not funding long-term assets like construction equipment. But Jason, you've had plenty of experience with people that come to you asking for a particular kind of finance, and you've been able to get them a better outcome through using your experience. Can you share a couple of those stories with us?
Yeah, look, you do see that a lot. And the job of a broker isn't to, if somebody comes to you and says, look, I need 100 grand, well, we've got to figure out how we get them that 100 grand. And that might be debt of finance, or it might be a business loan, or it might be a line of credit against their property. So there's lots of different ways of looking at it. And that's, that's the job of a broker, not to just say, well, let's do an unsecured business loan and we'll have 100 grand in your account tomorrow. But, you got to pay it back within 52 weeks, and let's not talk about the interest rate. So it's about looking at, what we think is the right solution to the client, and then presenting that to them to say, well, these are your options. So if I think of a couple of success stories, a lot of people come to me saying, I need 50 grand. or I need 100 grand, or, you know, I'm growing my business. And a lot of them haven't heard about debtor finance. And so a lot of the time it's about weighing up, well, do we do an unsecured business loan or do we do debtor finance? But if I think of one success story, if we talk about really briefly around equipment finances, I had a scaffolder introduced to me a couple of months ago, and they had an old truck, and it was a rent to buy situation. This guy had been in the scaffold industry for 20 years, but had only been a business owner for about the last 2 years. 2 years is the magic number for when lenders, the mainstream lenders, want to I won't say throw money at you, but want to lend you money. And if you're a property owner and you have an ABN that's older than 2 years old, it gets cheaper and easier. So this scaffolder had a rent to buy truck. It was probably maybe a 10, 15-year-old Isuzu truck. And look, they borrowed 50K and they still owed about 50K on it. So it was a very, very expensive option for them. They probably could have done it a lot more cheaply had their broker gone into bat for them about, you might be a new business, but you've got continuity of being a scaffolder. You've been doing this for 20 years. And that's when you might have been able to get a better rate with a different lender. But we came in, look, we cut their monthly payments by a third. So they were paying, you know, X amount per month. We reduced it by a third by simply doing a refinance, even shortening the term. And the interest rate was, look, it was astronomical, and we more than, you know, 2/3 cut the interest rate by 2/3. So the client couldn't believe it. And it's really just about being in touch with your clients and letting them know that if they need to get that expensive finance, then you just got to make sure you've got somebody there with you, whether it's your accountant or your broker, saying, well, it's expensive now, but now that you've been around for 2 years, it's not expensive. And, you know, we haven't touched on this a lot, but, you know, the rate that you're paying in interest can make or break your business. You know, I've got transport clients where they're paying very, very high rates because, you know, they don't have property. They're brand new in business. They had to use a rent to buy, you know, type scenario rather than go to one of the banks. So that's where it just comes back to, you know, it's the chicken and the egg. You know, like you might need to take out, when you're starting up, you might need to take out more expensive equipment finance or a more expensive business loan, but you want to move away from that as quickly as you can, because you'll just make more money. It'll be straight to your bottom line when you're paying 5% or 4% rather than 10% or 15%.
Yep, absolutely. And that can be the profit margin for a lot of businesses. That difference in interest makes a huge difference.
If you're turning over, you know, you're the accountant. Well, you know, like if you increase your gross profit by 3% and you're turning over $1 few million a year, that's a lot. That's a lot to your bottom line.
Oh, it makes a huge difference. So if we're increasing gross profit, makes a big difference on net profit, because your net profit, you're looking at your overheads, and a lot of people's overheads are fixed, but some of the big area that can be reduced in overheads is often your interest cost. And, you know, working there gets a better solution. Now, sometimes there's more than one solution to a need, because I think we've been investigating a situation where we have secured business debt secured by director's property, and looking to, you know, the director wants to sell that property. So we're looking at a situation there where there's a need for other types of financing. And we've come up with, I think, 3 types of financing in this situation.
Yeah.
And you want to talk about how that can work?
Yeah, look, for sure. If we're referring to that one we workshopped a little while ago, so basically, you know, you don't need to just use property. So, you know, you could remove in that situation, I think there was a line of credit secured by property. Now, there was a pretty decent sized debtors ledger there, and there was a trade finance component there as well. So, you know, rather than burning through cash to bring the goods in, we could get a trade finance facility in place. We could also get a debtor finance facility in place. And you know, we haven't really dived down into debtor finance, but there's facilities out there where you don't need to be locked in if it's just a short-term solution that you're looking for. And there's also, you know, there's also unsecured business lending. So in that situation there where the director wanted to sell and you know, or wanted to have the property released from security, there are mechanisms out there where you can get an unsecured business loan or some debtor finance facility in place and trade finance facility in place. And by putting it all together, you've solved the problem of having your property tied up.
Mm-hmm. So there's some good outcomes by being informed about your options.
Yeah. Look, absolutely. You don't know what you don't know. That's it. We've got a lot of people listening in here, Paul, and they're all at varying stages of their business journey. But look, you always got to be learning, and it's not, I don't need to know the ins and outs of financials and that's an accountant's job to explain that to me, and for a business owner, the broker's job is to just present what the solutions are. This is what this will mean for you, and this will allow us to free up your property, or this will allow us to tie up your property. And sometimes that business owner wants a quick fix, and they don't mind how much it's costing them because they can see the upside of what it's doing for their business. But they need to know how much it's costing them if they're paying tax debt, or if they're paying superannuation that's in arrears, or they're trying to make payroll. That's a problem that it runs a bit deeper than trying to get a quick business loan.
Yeah, absolutely. So just moving on from here, so improving your chance of success, so getting your application really solid, there's a few steps to make sure you tick off. The Australian Small Business and Family Enterprise Ombudsman's Office, in conjunction with Scottish Pacific and financial advisors and brokers, put together this finance fit checklist, and there's a number of steps in there, and we've touched on some of these already, but of all of these, which ones are probably the most critical?
Yeah, good question. I love that name, Paul. So Australian Small Business Funding Enterprise
Ombudsman.
Who came up with that name? That's a
I think a politician, because it doesn't roll off the tongue very nicely.
But, good one. Look, this is really beneficial stuff. Like we were talking about this before this webinar, and this is great stuff. And there's some really important things in here. I'd have to say I'd like to pick tax, PPSR as well. Plenty of businesses know what personal property security register are. Plenty don't. I'll give you an example, a very brief example, because I know we're running out of time, but I've got a great client there, a new client of mine. They're in the security industry. We've done a couple of vehicles for them, and they're growing. They've got some contracts coming up in Melbourne, funnily enough, and Sydney, doing patrols. They need a debtor finance facility. We found a great solution for them, a debtor financier that specialises in that industry. And we probably should have done this a little bit earlier, but the client said, "Look, I don't have any security over my business. I've got an overdraft, and that's it." I go, "Is that secured by your property?" He goes, "Yeah, I think it's secured by the property." I said, "It's not on the business, is it?" And he said, No, it's not on the business. But first thing we did was check to see if it's on the business, and they had what's called an ALPAP, or Present After Acquired Property, on their business, which just meant that a debtor financier could do nothing. All right, because the debt finance's only security is that debtor's ledger, so they needed that released.
Yep.
That bank was, really, really helpful. The bank was really, really helpful. Actually, we had a great business banker in there who put it up to credit, and that they came back to us very quickly. But their position is that they don't have enough equity in that property, and they cannot release the security over the business. So it's really important to know who's got what on your business. We even see, I'll stop talking about this then, but we see businesses that have paid something out 3 or 4 years ago, but still have the security on their business.
Yeah, I've seen that quite a lot. It happens quite a lot. And all of a sudden you do that, the PPSR report, and there's 6 or 7 pages of charges on there that the business owner, thinks, well, hang on, I've got no debt. Why have I got all these charges against me? So, knowing your information, knowing really well before you prepare any application is crucial. And this checklist is quite.
It's tedious stuff, which is why you've got to have your accountant all over it, or your finance broker all over it. You don't want to be discovering it with a bank, when you're almost at the finish line. The other thing I was going to touch on really briefly there is the ATO. Look, if you can't, I don't want to sound flippant when I say this, but if you can't pay your tax when it's due, then you need to probably sit down with your accountant or your business advisor and look at why that's the case. Why can't you pay your BAS? Why can't you pay your superannuation? It's important. Nobody loves paying tax, but we've all got to do it. So let's do it. So there's no surer way to bugger up your finance, your ability to borrow money than by having tax arrears.
Yeah.
It's important to not have tax arrears. A lot of people, they don't take seriously enough that they owe superannuation. Well, That's not the business owner's money. That's the employee's money. You might not like paying 9.5%, whatever it is, but you've got to do it. In my little business, I've got 2 full-time staff, and the best advice my accountant gave me is he said, Jason, pay your super when you pay your wages. I pay wages monthly. Yes, monthly. It's not your money. Pay it. Don't pay it quarterly. You only need to pay it quarterly, but pay it monthly. It's not yours.
It's a cost of your business. So yeah, you factor that in. You should be paying it.
So look, you've got to get familiar with that ATO portal, the integrated client account. Everyone's asking for that. So again, I don't want to sound flippant, but just make sure you've got a business that's making enough money that you're paying your tax on time. And if you're not paying your tax on time, you either haven't got a good enough gross profit, or it could be, what I like to call lifestyle issues, and that's director lifestyle issues. You're spending too much money.
Oh, we see that so many times. It's taking the money out of the business before you've paid your expenses and before you generated the income. It's just the fastest way to financial disaster for a business. Yeah, right. See it a lot.
Yeah. And the stats are pretty scary, Paul, aren't they? Like, I can't remember off the top of my head, but it's pretty much 50% of businesses fail in their first 5 years.
Oh yeah. So many, and a lot of it is because of poor planning and poor cash flow management, and maybe the wrong type of funding, and that's something we're trying to address today. So, so I guess moving forward, just 5 quick things to fix. So the business case, having a good reason for borrowing.
Yeah. So I think we touched on this before. If you're a carpenter and you're looking for a ute, and this ute is going to get you from point A to point B and have the cattle dog in the back and load it up and all that, that's a good business case for borrowing, to get finance on that. If that ute turns into, $150,000 Tesla or, a Porsche, that's not a great business case for borrowing. So the very first question that these lenders ask is, what is this asset? What's this asset going to do for the business? How's it going to help it make more revenue or make more profit? Or win more business. So that's what it really comes down to. We're talking about tier 1 lenders here. The business loan guys are a little bit more relaxed about that. They don't like working capital. They don't want anybody saying it's working capital. They want to drill down on that. But it's really important. Like, we did some sort of plant machinery for a manufacturer the other day. We put together in our submission what this piece of machinery was going to do for them. It was only a $20,000 piece of machinery. It's quite old as well. It's about 10 years old, but it was just going to allow them to stop sending that part of the job out and paying more to get that done. They're going to do it in-house. It was going to be paid back in 3 years. It was a great interest rate. It was a no-brainer. So the business case is critical.
Yep. Great. And financials, we've talked about this, getting your financials up to date and making sure you've got that profitable history in there.
Really, really important. Your broker, the lenders and that will do the add backs and look at the serviceability. Whenever there's financials involved, they are looking at serviceability, and it's not what the business owner's idea of serviceability is, and that is that I've never missed a payment. They look at, debt servicing ratios, and they put their add backs in there and they run it through a special Excel spreadsheet. So having up-to-date financials where the balance sheet matches up with the profit and loss and is telling the right story, the facts, is really important.
Yeah, great. And look, the one thing we like to do with businesses is run them through a health check and actually look at, are there issues with their collections? Are there issues with their sales? Like, how quickly are they converting sales into cash? Do they have the ability to service their debts? Are they spending too much on non-productive assets, or are they taking too much cash out of the business? So what are the health signs or warning signs about the business? And that's something we like to do with everybody, and just give that snapshot of, just how healthy is your business. Because if you don't have a healthy business, you're going to have trouble, firstly, borrowing, and second, servicing it. And there's more and more these cash flow forecasts and scenarios are becoming, well, we're being told they're being requested. I'm not sure that that's exactly the same that what you're seeing from the banks. Is that right, Jason?
Look, with straightforward equipment finance, no. With complicated commercial finance deals, absolutely. Some of them will even throw in there the 3-way forecast, which is very involved. But that's for the larger, borrowings. And it's important. I know some businesses that swear by having this cash flow forecasting and budgeting in place, and other businesses who have never looked at it.
Yep. I think one of the reasons why a lot of businesses haven't done it in the past is the systems just weren't there to make it cost effective or timely to do. And with the new advancements in accounting and other accounting tools and other tools like your Xeros and your QuickBooks, getting the data in to a format where you can easily prepare a forecast and run scenarios is so much easier these days. That I love the way technology has given small and medium business owners the ability to do things or get the information that used to be solely the domain of the large businesses that had big departments doing this stuff. So it is a bit easier. Even if it's not required, I would recommend it as a good step. And this is the really important one here. When any finance application, get somebody who knows their stuff working for you. Engage a broker. I've seen so many examples of where the business owner has gone alone and got rejected because they haven't done the process correctly, or they've got the wrong type, or they've just not been aware of it. And this is where your broker really provides value. The different types of finance that we've talked about, or even the different lenders. You may not know about a particular lender, and that's the broker's role. And Jason, how many lenders do you deal with?
We've got on our panel, we've got about 60. We've got a panel of about 60 lenders, and that's right across debtor finance, business loans, equipment finance. There'd be 60. And my support team and myself, spend some time every week just going over who's changed their credit policy and what they're doing in that. And brokers in their simplest form, what we're doing is comparing. We're like a mortgage broker. We're just comparing what is the best rate out there and the best term for this client's situation. And the other thing, and I'm obviously very biased about having a broker, but the other thing is we're the conduit to the bank. So when the bank's saying, a stupid question like somebody's buying a $40,000 vehicle and they're in professional services and they're saying, what will they use the vehicle for? Well, we handle that question for the client, and rather than the client blowing up and, getting all emotionally involved with it, we handle that for them. So when we haven't had a response for 4 hours, we re-forward that email, and say, well, you're coming back to us, and do all that chasing so the client doesn't have to worry about it. And then just update the client every day.
Yeah. And so as the business owner, you've got your broker working for you, so you can concentrate on actually running your business and creating value there. So use the skills of the experts.
Yeah, exactly. I agree completely.
Yeah, because look, we are here to help you create a better business. So, we're looking here at a conversation between accountant and finance broker, two different skill sets, but both are going to add a lot of value to your business and get you the best outcome.
Thanks for listening. Do you have a question you'd like our team of experts to answer? If you do, send your question to podcast@thebusinessbehindyourbusiness.com. To hear more from The Business Behind Your Business, don't forget to subscribe using your favourite podcast player. Or you can visit the businessbehindyourbusiness.com website.